Hi there everyone. In today's video I wanted to discuss the already much discussed company and stock of Alibaba. There have been some developments in the past few months that I think make the stock a lot more interesting, particularly with regards to its future within the near term. Alright, without further ado, let's take a look. For those of you that do know the business, you will also probably know that the stock price reached an all-time high back in November of 2020, and since then there has been a very steep decline, and the price today is roughly 70% lower than it was at that point in time. There are a number of major reasons for this, and I'll do my best to touch on the major points through the rest of this video. The first reason for this is that the Chinese government implemented a number of regulations and changes to legislation that impacted Alibaba and other companies within the Chinese technology kind of arena. The Chinese government stated several reasons for these new regulations. First of all, they wanted more control over these companies. They didn't want them becoming more powerful than the state. They were also worried about the data that these companies held and what they might do with it. And they were also worried about competition within their economy. Another key reason for this regulation is, well, the stated reason was that the government was worried about a concentration of wealth within very few individuals and businesses. As part of this, a number of very interesting things happened, things that I believe are actually good for the population. Things such as within Alibaba's home province, the minimum wage was raised significantly, so Alibaba had to start paying much higher wages to the people within that province. There were also calls for large companies to donate to social causes, and a number of very big companies did just that, donating billions of dollars to these social causes. On top of this, we also had the zero COVID policy within China. So China is not a democratic country. The country is run by a single party, and the level of control that that party has allowed them to shut down the economy. At first, it looked like this was working quite well, but over time it became problematic, with the country opening and closing at very short notice, thereby completely disrupting the economy. Since Alibaba operates within that economy, it is also an international company, but China is a large market for it. This created problems for the business. This was a huge impact on revenue at a time when profitability was being hit by changes within the company to address the government's newly implemented regulations. Now, there were several factors involved, and I don't have a tab open for this, but China's economy collapsed through the past 2.5 years, creating all sorts of trouble, not just for technology businesses, but also for the real estate market, which is a very large part of their GDP. Any type of economic collapse is going to obliterate consumer sentiment. And so people within the economy start spending a lot less money, and this will hit all companies, including Alibaba. Another enormous risk that was raised, and this comes up every few years with regards to Chinese companies, was the risk, although this time it had a deadline on it, a risk of Alibaba being delisted from US stock exchanges. Now, when companies list on stock exchanges, that becomes one source of raising funds. So if these businesses were to delist from the US stock exchanges, there's the question around what would happen to the investors that had invested in those companies, but also that avenue for fundraising would just disappear. And the US is a particularly good market for fundraising. So this risk was yet another enormous risk in a long list of risks, as you can see. And finally, as I mentioned earlier, it wasn't just that China was experiencing an enormous economic collapse. The rest of the world has been experiencing a slowdown in global growth. And Alibaba is not just a domestic company for the Chinese market. A large part of their revenue also comes from the international market. And because through the past 2-3 years, global growth has been slowing down, consumers have been spending less, that also impacts Alibaba's revenues and therefore their earnings. Now, because of these risks, and because Alibaba is a Chinese company, first and foremost, its share price trades at an enormous discount to the share price that it would have if it was a US company. If it was a US company, I think it would be trading at 2 to 3 times the current share price easily. But it is not a US company, it is a Chinese business, and therefore it is trading at this discount because of all the things that I've just mentioned. However, one of the reasons that I wanted to make this video is because things are changing, the winds are turning. The first major point is that the Chinese economy is beginning to recover. There are some very strong indications within the macro data out of China that economic growth is starting to take off. We've seen that their GDP number was incredibly strong, but there are other data points too. Consumer sentiment is looking decent. Exports from China surprised massively to the upper side a few days ago. And all through the economy, we're beginning to see signs of growth and strong, rapid growth too. Now, recovery from the kind of economic collapse that China's experienced will be uneven, and some areas will take much longer to recover than others. But the fact that we're starting to see this in several places is good news for China. In addition to this, it looks like the phase of lockdowns is in the rearview mirror, as is the period of large-scale changes to regulation and legislation. We've also seen that the US and China have been working closely in order to mitigate this risk of delisting of Chinese companies listed within the US. And this has gone as far as US regulators been flown out to Hong Kong to go through the books of Chinese companies. The rebound within the Chinese economy is not just happening on its own. The government has implemented measure after measure in order to start stoking the embers of that fire, to push the economy to grow. They want to have a successful country. And the fact that inflation is still so low within the country means that there's further that they can go to continue stoking those embers. So the conditions under which Alibaba is operating look to be improving. It's going to take some time, but they are already looking much better. What about the business itself? Well, Alibaba is facing competition from a number of different companies. And part of the reason that China implemented those regulations in the first place is because they did want to have more competition within their economy. I'll get back to the point of competition in a minute, but if we look at the numbers with regards to Alibaba, we can see that revenue was growing very strongly until it wasn't. The pause in revenue growth came at the time when all of the events that I mentioned previously hit the company and impacted revenue significantly. However, forecasts are now showing that growth in revenue is expected to start picking up through this year. Net profit is another area that was growing quite nicely and then was hit once again by all the things that I mentioned before. Change in your business to address changes in regulation is a very costly experience, as is giving away billions of dollars for social causes. But if we listen to what management has to say, as well as what analysts think might happen, it looks as though profitability will rise to levels that we've seen recently within the near-term future. I'm not going to run through all of the numbers on screen because that's an entire video in of itself, but things such as the P ratio and PG ratio are very favorable. Return on capital and equity for this company are very strong. They do need to get their margins back up, but the margins have been impacted by all the challenges, the recent challenges that they've seen. The company has a lot of cash on hand. It has no debt. It has a lot of spare cash, actually. And I think that without large-scale challenges like the company has seen in the past few years, the growth in revenue and profitability is likely to start compounding at something like we saw prior to these things happening. I don't think that's an unreasonable thing to expect. If we were to look at valuation metrics, so how do we value this company? So first of all, comparing it to its historical self, the company is cheaper than it's been for years and years. There are things that I think of more as just an indication, but you can see that the price to sales ratio is, the mean is 6.5 over the past 5 or so years, and it's sitting at just above 2, whereas the EV over EBITDA has a mean of 24 or 25 and is sitting at around 10. So this company is dirt cheap compared to its historical self. If we compare it to a similar US company, which I know we shouldn't really do because they're different markets and because Alibaba and Amazon are similar companies but not exactly the same. But I do think that there is some value in comparing them when trying to decide whether Alibaba itself is a cheap stock. And if we look at things like PE ratios, PS ratios, I think every kind of historic valuation metric within this table, except for price to sales, Alibaba wins out over Amazon. The company is highly profitable. There's very little debt when it comes to Alibaba. And so we can see that compared to its closest US competitor, this is a company that is very cheap. So cheap compared to itself, cheap compared to a US competitor. So it looks as though Alibaba continues to be a strong company with a share price that is cheap and operating within an economy that has completely collapsed, but is now showing those first green shoots of a rebound. Competition continues to be a challenge for Alibaba, and it is a healthy challenge. We've seen the impacts of competition on Alibaba's revenue and earnings through the past dozen or so earnings reports. But the company is now doing something very interesting that in part will help them fend off some of that competition. The particular change that I'm talking about here is that Alibaba announced not so long ago that it is to split into 6 different groups and explore IPOs of those different groups. And each of those companies will have its own CEO, management team. They'll be run more or less independently. This is incredibly interesting for a number of different reasons. Now, stepping back for a minute, companies get very big usually by creating different products and services, and they have varying degrees of success in those products and services, usually huge success, at least in some of those areas. When they get large enough, maybe they don't create them themselves, but they buy other companies to augment whatever capabilities they have in areas that they think will create synergies with what they already own. Now, there are a number of good reasons for companies to grow large. In part, it means that they have diversification across their products and services, so that if there's weakness in one particular area, they're making money somewhere else. Growing large also usually means you have access to a lot more money, so you have deep pockets, and in challenging times, deep pockets can help you survive, weather the storm. However, the problem with growing large is that the bigger you become, the more bureaucratic your company gets, and there's typically an increase in cost of you doing anything. The cost of change within your business grows as you become bigger. Think about those nimble startups that can do things very quickly versus those very large companies that take ages to achieve the same goals. Probably the most interesting point about this split is it means that there will be 6 groups that are able to be laser focused on their particular area, becoming a lot more efficient in what they do. I highlighted on screen the 6 areas that Alibaba's business will be split into. And I think that this will be an incredible catalyst to unlocking value within the company. It means that we will probably see a lot more innovation within those particular areas because the company can move a lot more quickly. It can be a lot more efficient in its capital allocation. And so it should be able to gain an edge in fending off the competitors and gaining a larger slice of those individual pies. Another reason that I'm quite excited about this split is that it aligns quite nicely with China's new policy of companies not growing too large, not dominating a particular area too much. Instead of being one large company, Alibaba instead becomes 6 smaller companies. And the final reason that I find this quite interesting is that there will be someone that oversees all 6 companies. I think the current CEO will become that person. And now, instead of him being involved in the day-to-day operations of this one large company, he has his 6 CEOs, and instead he can focus more on the strategy, top-level management of the company. So in summary, China remains a risky geography to invest in. I acknowledge that, and I'm not going to allocate my entire portfolio to Chinese businesses, but the picture is improving. And within that particular geography, there are large companies which are less risky than smaller companies. They continue to be fantastic businesses, like Alibaba is, and which are trading at enormous discounts to where they've been for many, many years, and to counterparts in other geographies. On top of this, there are immediate catalysts that indicate that companies like Alibaba are going to have very good revenue and earnings growth through the next few months and years. The 2 catalysts that I've mentioned within this particular video being China rebounding from the collapse and returning to economic growth, and Alibaba splitting its enormous company into 6 smaller, more focused businesses. All right, I hope you found that useful. I plan to make more videos like this each week going forward. Speak to you soon. Goodbye.